I have Alexis Meeks here. She's a certified public accountant from
Karp, Ackerman, Skabowski, and Hogan.
Okay, that's always a lot for me to say, so I figured I'd ask you to say it, Alexis. And we're going to do a few weeks here with Alexis talking about the benefits of taxes, or owning a property or owning a home, and some of the tax benefits for home buyers. So, Alexis, can you walk us through a little bit of what that would offer a potential home buyer for tax benefits?
Sure. I guess the biggest change to somebody when they purchase a home is that they go from taking what's considered the standard deduction, so what anyone gets on their tax return as a single individual, to taking an itemized deduction, which means you get to deduct things like your mortgage interest, your real estate taxes, and then there are additional items such as your medical expenses, charitable contributions, your state withholding, and some business expenses as well.
Well, that's interesting, because a lot of people always think, well, it's just the mortgage interest that they're going to deduct, but then they later find out that the property tax, and of course we have some healthy property taxes around here, and that offers a pretty big deduction for someone. But you're also saying that there are other deductions as you change the type of IRS forms that you're filling out.
Correct.
And that's called, it's an itemized tax?
It's itemized deductions. They're reported on your Schedule A.
And then someone who was not a homeowner, they wouldn't file an itemized tax deduction, return?
Theoretically, in most scenarios, owning a home is what throws you into the ability to take those itemized deductions, unless you have very significant medical bills or charitable contributions or a large amount of job expenses that aren't reimbursed by the company you work for.
Right. So when you go into a itemized deduction, you can write off the interest on the mortgage, the taxes, what other things? So unrelated work expenses.
Yep. Job expenses and medical expenses are all subject based on your income, a percentage of your income. So if you have medical expenses, you have to reach a threshold of 7.5% of your income before you're allowed to deduct them. And job expenses are 2% of your income.
Okay. So what we're going to do is I'm going to have Alexis just kind of walk us through a scenario of exactly what this means for someone and really what those numbers take a look and what they look like. Okay, Alexis, take us through the numbers and give us an example. Someone who is renting right now and they're thinking about buying. Show us what the tax benefits possibly could be for someone.
Okay. So I used as an example an individual that's making $50,000 a year as a W-2 employee. And I used that they were claiming single zero on their W-4 form with their employer and nothing else, no other complications within their return. With that being said, again, they get their standard deduction, and then their bottom line overpayment for the tax year was about $1,800. Then I threw in them purchasing a home with a mortgage of $175,000 over 30 years at 3.25% and real estate taxes of $5,500. Okay. With that, instead of the standard deduction of $5,800, it pushes them into itemized deductions, and they end up having deductions of $14,000, which then gives them a refund of $3,600, which is double what they were getting previously. And that's just on the federal side. Then in New York State or any state that they're in, they also then get the benefit of those itemized deductions as well. Okay,
great. So that's pretty significant. It's double the amount. And next week we'll talk a little bit about what someone could do. They could wait and they could get that big return at the end of the year, but you also have some suggestions on what they could do during the working year to see a little bit more of that income in their check, so that they can, therefore make the little bit higher mortgage payment potentially that they're looking at.